All right. Welcome, everyone. I'm so pleased to have all of you with me tonight. We're gonna be working something a little different. And I call that, I um, call it Christmas in August. So basically, what the strategy we're gonna work on tonight is, but something which is been around for a long time and but I don't know if it has been explained the proper way. So it has kind of made a lot of people wary of this strategy. So they kind of stay away because of the lack of maybe understanding or lack of understanding of the risks, and also understanding the what is the rewards. So one of the strategies that a lot of professionals use is something called uh, selling options, or in this case, selling puts, in order to achieve two goals. Number one is having an income stream, could be on weekly or monthly basis. And the other thing is buying their favorite stock at a discount price. And hopefully by the end of this, our presentation, hopefully it will be more clear of what we are talking about. So the strategy obviously involves the options. So for me, I think one of the reasons a lot of people avoid playing options, and this includes a lot of portfolio managers that I know of, is the lack of understanding of the foundation of the options and what is the goal of an option. And because of that, there's a lot of the complexity, which it shouldn't be. So in a short phrase, I should say, once you understand the two concepts. One is the first concept is understanding the calls and puts. And the second concept is understanding of buying and selling calls and puts. Once you master that, and I'm hoping that you will really dig deep and understand it completely, every other strategy you will notice that it will make sense. And you will understand why some of the professional traders, they they use these strategies to um, supplement their uh, income. They also can use it as a hedge in different ways. So most of you know that, especially you're familiar with buying calls and buying puts. Basically, there are two types of options, which are they're really derivatives. They don't have value on their own. They're driving from some underlying asset. It could be commodities, or in the futures, it could be, in this case, stocks, ETFs. So what happens, the calls are really, you're bullish, you're calling up, you're hoping that your investments will go up, and puts is putting down. Your goal is to see that your holdings, you think they're going to go down, and that's how you're going to make money. So that's an easy concept. And the second concept is buying them, and that's when you buy, you have the right, not obligation. So that's also understood with a lot of investors, because when you buy something, it's the you pay a premium for the privilege of hoping that on the really low margins and the large leverage with you, you can make a lot of money. So, and that time, if it doesn't go your way, basically what you lost, or you risked, was the premium that you paid. The complexity starts when we talk about selling the options. And that's where I think there's some misconception. With selling, in reality, you're the ones who are on the other side of the options, and you are giving the privilege for the option buyer to have that asset, and you're obligated to deliver it. Either if you sold a call, you are obligated to sell that asset to them. And if you were the option writer on the put side, you were obligated to to buy that asset from them as low as it could be. You are obligated to do that. And this is where the difference comes from. So first of all, let's work on what effects, and this is very important for the strategy we're going to talk about. So this is something that you really have to master to understand what affects the options pricing. And there are, as you could see, there's 6, but there are really there are 3 or 4 ones, I would say, they're the majority. Obviously, the stock price. If the stock price goes up, remember the call options, it will go up because we are hoping it will go up because we are bullish about the stock. Opposite way, the put price will go down because putting, you were betting it's going to go down. So this is pretty clear. The strike and your exercise price. Now, the farther it is from where we are, obviously the price of that option is lower because the probability of reaching there is much lower. So the higher the price, the lower the call price. The opposite is about put price, because the higher it is, that means you're more in the money. That means you're obviously much lower than the price that we were striking at. So it's a positive relationship to put price. The time to maturity works for both calls and put options. So the longer the exercise price, which is the time of expiration, so you can make a bet that the stock is going to go up in next week, next month, next 2 months, next 3 months, a year. Obviously, the longer the time, the probability of this is happening is much larger. So obviously you have to pay a higher premium. So it doesn't matter if it goes up or go down, because the probability is high, then that's what it affects the price of the options, and that's where it is higher when the time to maturity is longer. The volatility also is a big factor, because obviously when something is predictable, when you know some investment has a steady pattern, it is a lot easier to predict. And because of the predictability of that, then you don't have to pay a lot of premium for it. On the other hand, if something is very volatile, then it is pretty unpredictable. And the opposite side, whoever is selling the options, writing the options, because they know anytime that price could be hit and they will be obligated to deliver, then obviously they expect more premium from you. So the volatility is both positively related to calls and the puts. The last two in these days are not as important, but still it's good to know. For instance, stock paying dividends. I mean, dividend paying stocks, basically it has an inverse to the call price, but because as you know, if the stock pays the dividends, what happens is the price of that stock will go down. Accordingly, then the call price will go down. Obviously, because the price goes down, it affects the put price positively. On the other hand, when interest rates, especially when they were high, they had a positive effect. It is the cost of opportunity. So the call price, with the higher the interest rates, when they go higher, the call price goes up, and it affects the put price. So once you master this, then I think everything else will be very much clear. So there's 2 when we're talking about selling the options. Actually, there's 3, but the main ones that you have to focus on is the volatility and the time to maturity. Once we master that, we know that how much time we have left and what kind of the volatility that our options have, then we can have a pattern and have a strategy to take advantage of the opportunity. So tonight we're going to talk about put options, and the strategy we're going to talk about is selling the put options, and that's how we can have a stream of income, and also it will help us to buy our favorite stock at a discount. And let's see how that could happen. So there's few things you should know before we go in details. Is the basic things about the options. Number one, when you're selling put, you're actually obligated to purchase the shares at the strike price upon the exercise time. So That's number one. Number two, this is where you have to change your behavior and you have to decide whether you want to be insurance company or the insured. So when you're selling, in this case, the put options, you're basically are the insurance company. You're the one who are collecting the premiums. And when you're collecting the premiums, you're hoping there's not going to be any accident. And when there's not an accident, you will just keep that premium month after month or week after week. Now, a major accident could happen. Then you're obligated to pay. And let's say there was a car accident or it was homeowners or whatever happened, you're obligated to take care of that. Now, as an insured, you don't have to worry about it because you just pay the premium. And as long as you don't have an accident, the money goes and you pay the premium. Your goal is really basically you're hedging yourself just in case anything happened. So it could be positive or negative in our options case. So in insurance company's case, basically, again, it might make it a little more clear. When you're, the reason they charge a 40-year-old different than a 17-year-old is that's the volatility. It's the unpredictability. It's the experience. And when they have a sports car, that's when they know because of, again, the unpredictability of the driver with that car, they have to collect more premium. So when you are selling an option, you're basically, in put option, you're basically the insurance company. This is basic, but it's still important. When you purchase or you sell, one contract in options equals to 100 shares. So whenever premium you pay or receive, it's times 100. In selling options, in the put option, the maximum profit you will ever make is the premium that you collected at the moment that you wrote that option. This is very important to understand where the break-even price is, because that's when you know how much your risk is. So the strike price, whatever you chose, and we will have an example, minus your premium that you collected is your break-even price. So if your strike price was $25 and you collected $1, your break-even price will be $24. So what that translates is, what is your maximum loss? Maximum loss will be the break-even price. And what is the lowest price that stock can go down? And because you're selling the put, remember, you're betting that it's not going to go down, but if it goes down, it can never go below zero. So your break-even price minus zero is your really break-even price. So your maximum loss is $24. So you collected one, but you could have a loss of $24. Now, majority of time when you're selling the puts, depending on what level of options that your broker has offered you, it's cash secure. So you have to make sure that you have enough capital in your account to purchase those shares that if it could be exercised. So for instance, if the strike price was $25, you bought one contract, you should have $2,500 in your account, because what happens if it needed to be exercised, the broker is gonna actually ask you to buy those and pay them $2,500 to be the proud owner of those shares. Now, one of the, obviously, you don't want to buy a company that is going to go to zero. So one of the things you should do, you should look at the Z-score of your company to make sure that the likelihood of this company going bankrupt is as little as possible, well, obviously close to zero, because the whole thing about options and buying stocks is all about the probabilities and the right analysis. Another mistake I think a lot of option writers make is they want to squeeze every penny out of it. They want to have 2 cents, last 1 penny. No, have targets in place when you open your account or when you got the premium immediately. What I do, I already got my targets in place. Whether I buy options or sell options, I know what I would be happy with, what profits. So immediately I have my targets in place. The last but not least, one before the last is the stock that you're looking at. Make sure this is the stock that you really want to own. So when you're selling an option on this stock, you want to look at it two ways. As I mentioned, you're actually collecting the premium, but also this is a stock that you wouldn't mind owning it if it did go to the price that you were going to. So I give you one example. I've shared it before. On March 23rd of 2020, Disney was around trading around $90 plus. And what happened was at that time, when I looked at it, I said, you know, I would love to own Disney at $50. And because of that, the premium was $2.50. So actually, I went 90 days, which is much longer than what I suggest in most of the option. But because I didn't mind owning Disney at $50, I got paid $2.50 premium. And the worst case scenario would have been that the price of that option would have hit $50 or even lower. Because I was determined to own Disney at $50, it wouldn't have bothered me because I knew long run, based on our fundamental analysis, we knew with all the assets that Disney had, it was definitely more than $50. I mean, $37.50 was just their theme parks and other things. So when you sit down and look at the segments of Disney, it was a steal. So what I did, I was very comfortable buying few contracts, selling few contracts at Disney because I knew I'm buying Disney almost at a 40 or 50% discount. So it made a lot of sense to me to actually sell the puts on Disney. And that's what you should do. You should do analysis. You should be clear on why you bought it, and you should be comfortable on owning this stock if it ever happened. If not, then you have to really watch your risk and also manage your profit targets. The last but not least, I mentioned this, these are very important of some of the candidates that you look for. Besides the stocks that you know, maybe you can do some screening, but also you're familiar. You want to look at, like for instance, if you did channels, as far as the strategy from technical analysis, some stocks, they go into channels and they have a predictable pattern. That would be one candidate. So you can use the squeeze when the uh, momentum is very low, the Bollinger Bands are narrow, Keltner Bands are narrow. There's this quietness, and or the opposite when their Bollinger Bands are very wide, so there's a lot of volatility, and you feel there's too much volatility and it has to go to norm. So you can check and screen based on these, and then if the momentum has gone up and there's a stock that you feel is changing, it's slowing down, maybe those are the times that you want to go and sell the options, which is opposite of buying the options. One of the things you have to be aware of while we're talking about selling options is what level you're approved of. So the level 1 is available for almost everyone. When you talk to your broker, you can actually tell them, based on your experience, usually, well, you can say how long you've been doing stocks and trading exchange traded funds and options. And based on that, they give you level 1, 2, 3, and 4. 4 is the most advanced. You have to have a lot of experience and the capital. The level 1 is available for everyone, and it's including your retirement accounts. And what level 1 allows you to do, you could do covered calls and cash secured puts. So this is available to everyone in a sense that as long as you have the capital to do this, then this is a good place to start, especially if you have your retirement account, you want to have like some extra income coming in. That's maybe a good place to do cash secured puts. And that, again, that's the level 1. Level 2 is, you can buy and sell options, naked ones. And then level 3 is option spreads. Majority of people, if you've been around for a few years and you've been doing investing, usually you do qualify up to level 3. Level 4 is naked calls and puts, which again, in that case, sometimes you only need 20% margin rather than 100%, but the brokers are pretty careful. But again, depending on your broker, you could also be eligible for that, but then be taking a lot of risk because they are naked. And again, you could be called margins and you have to put the money down. So I thought that was important because it's important to know what level you're approved of. Let's start with an example. We just talked about what is a selling put and then why people even will do this. Because what happens in this example, let's say there was a stock that it was May 18th, exactly 3 months ago, and you decided stock price was at $54.91, and it was, you wanted to have expiration date of June 19th, and you had 32 days to go. And the strike price that you decided to sell, the put at, was $54. So you're at $54.91, the put is 54, so it's out of money because you know it's below what price you're in now. So the premium for that was, option price was $1. So what that meant, you collected $1 because you only had one contract. Remember, each contract represents $100. So one contract times 100, that means you collected $100. Now, the break even, if you recall, we mentioned that the strike price minus your premium collected is equal your break even, which is $53. So 54 minus 1 is $53. The time value, which is really extrinsic value, is the value that is not part of your stock price, which is your, since you're out of money, it's the full $1 is extrinsic value, is time value, then that's the time value. Now, in order to get to $53 from $54.91, you have to drop $3.48% to break even. Now, if the option expired worthless and it was above the $54, you will collect your full $1, and that represents 1.89% return on your money for that 1 month. And basically you collected that $1 divided by 53, that's 1.89%. Now per annum becomes 2152. This is assuming that every month you do the same thing. Now this is a scary part. And why would anyone will even think about doing this? Because your maximum loss is $5,300, which is 53 times 100. Your maximum gain is 100. So the risk to reward is 53 to 1. And this is where a lot of people get scared because they look at the losses, compare the risk compared to the reward, and they see there's no reason to do this. So you have to remember, number one, when you're selling options, it's not just about the direction, it's about not getting there. So it's all about the probability. So if I am selling a put at 53, my goal is not getting there. And that's where the probability comes into the picture. And that's what you have to watch the different numbers to see what is the odds of getting to that number. So the goal is having the little pieces at a time, and eventually they become big pieces. So you're getting small profits at a time with a more consistency. Then that's what professionals, they look at what are the odds of hitting the numbers that they're looking at. So in this case, 5,300 scared, that means the company went bankrupt and it has zero value. And that goes back to your analysis of what you were working on as far as fundamentally. So the most important thing, besides the volatility, is the time value. So when you're a buyer of an option, the longer the time, the more premium you pay. As the time gets closer, now you're losing that time value because now the odds are turning against you. As an option writer, as option seller, it's becoming your friend. So in the beginning, when let's say you have 120 days to 90 days, the option, the time value, which is called theta, is very little. As we get to 90 to 60 days, it's a little more, about 10% more. And then as we get from 60 days and on, now it's getting a little more and more. It's the last 30 days, you can see the time is your ally. And that's where a lot of, when we talk about selling your options, that's what it's important to magnify this. And I usually say 45 days, and because the, when the time value is getting more and more in the sense that it's depreciating, that means your put option is going down. That's what you want, because you wanted eventually the put option be zero, and that's how you put the whole premium in your pocket. The question is, what type of option you have to use when you're selling put options? Now, as you know, there's in the money. That means it is already has intrinsic value. At the money, that means you're right on the money with the stock prices today, and there's out of money. Now, let's assume the stock price is at $25 right now. So if you buy an option, which is, I mean, sell an option at 25, that's called at the money. If you buy something at, let's say in this case is 27, you're in the money because you already are $2 more. So you're in the money. If the stock price is at 25 and the put strike that you're getting is 27, that's you're in the money. If you go to $23, that's out of money because 23 is less than 25, so you haven't gotten there. So it's in that's distance you're hoping you will, you know, that's you'll never get there. But the question is, which one of these three you should choose? In the money basically works almost like a call option. Basically, if you're at 25, you're buying the 27 or $28 put option. It has a lot of intrinsic value, so it moves like a stock. So you really have to be very convinced that this stock has momentum, it's going to go up. It is a very bullish stock, and you're taking a risk by selling a put at, again, when you sell it at 27, that means you're obligated to buy it at 27. But if you feel it's going to go up, then that might be a good strategy to buy the in the money stock. And as it goes up dollar for dollar, then that means your option is basically is more valuable in the sense that you're selling them. It's getting away from the 27, getting away from your 25. So you can go ahead and take a nice profit on that. At the money is your semi-bullish. The exercise that I usually do is out of money, and I will show you an example. Because my whole goal is that I want to make sure this put will never reach that strike price that I have chosen. And my goal is the odds have to be in my corner as much as possible. So that's what I use out of money. So let's take a look at what are my 7 rules of my choosing when I sell put options, and what criteria do I use. First one is I want to make sure, remember, implied volatility is one of the portions that it part of the options pricing. So if the implied volatility is low and if it goes high, the price of option goes up. My goal is when I sell it, I want the price of option to go down. So basically I look for implied volatility, which is higher than average and higher than historical volatility, because I want to see that volatility should come down. So basically what I do is I look around and I look for the higher implied volatility than historical volatility. But also I'm careful that it's not too high, because that means there could be some volatility ahead, more so, especially when I'm working on the weekly options, because I cannot use this back and forth options And I'm also wary of big news and earnings because, again, earnings bring volatility. So I try to make sure either the earnings have already been out or they're away from my strike price. My second rule is I want to make sure the bid-ask spread is as little as possible because there's no sense of, let's say, I buy something at I sell it at 20 cents, and if I turn around and buy it back, it's 30 cents. So immediately there's like 50% loss. So we like to have a low bid ask spread up between 1 penny to 5 cents. And this way it gives us the advantage of at least knowing that um, we have very little spread that we have to worry about. So the third one is I like to have at least some volume. I mean, 10 is the minimum. I like to have a lot more, but I want to have some activity because we want some liquidity. And that's the minimum of open interest, at least 100 in the strike option that I like to choose. And again, the more the open interest, the more liquidity, and that translates to less bid-ask spread. I mentioned about time decay, and that's why if you're using monthly, not weekly is different. That's, you can play on a very liquid stocks, but let's say you're using the monthly stocks and you really like some stocks, and usually you want to have it at about 45 days. If you really like that stock, you wouldn't mind holding, selling the option 90 days out because there's a lot of premium at that. But normally because the time decay starts about 30 days, so it's better to look at about 45 days out, 30 to 45 days out. Delta, which is the sensitivity of the stock, and the option to the stock, is really basically the probability of this stock being in the money or at the money by the time that it's expiring. So the higher the number of delta, the more probability and the more correlations to the stock price. So if the stock price goes down $1 and delta is 30, the option price goes down to 30 cents. So when you look at your criteria, you want to have a negative 30. So for call options are positive because the price of options is positively correlated to the stock price. For the put options, a negative because if stock goes up, the price goes down. That's why you see the negative. But the idea is you want to go 30 or less. In my case, I would love to have like a 10. What that means is the chances of this stock to be at the money is or in the money is only 10%. So remember, the whole idea about selling options is you want to make sure it does not get there. So if I bought something at 25, my goal is not getting to 20 because let's say I'm selling the 20. So I want to make sure as little as probability of getting there. And that's my next criteria is in the money probability of 20% or lower. And that's what I aim at because I want to have less probability that this option is going to be at the money at that time. This is a little trick that I use is that I want to make sure the premium that I collect is at least 1% of the stock price that is today, that at the moment that I bought. So if a stock is at $30, and in this case, let's say some stock is at 30, I want to collect at least 30 cents premium. Now, I do not look at anything under 20 cents. So basically, that's the minimum I would like to collect. So you don't want to go collect 15 cents or 10 cents. So make sure that that makes it worthwhile. I mean, making $20 or $15 on one contract, it's not worth the hassle that you're taking a chance. So at least have 20 cents. The last but not least is that you really, again, I mentioned don't squeeze everything, put your profit target. So start, again, covering or buying back when you have a big moves in the stock. So let's say the stock was 30, goes up to 31 or 32. Don't keep thinking, oh, you know what, it's gonna stay up there. I'm gonna collect my 100% premium. I'm gonna stay with it. If it hits 50% target, get out of it. So if you don't mind, we'll do one example. So hopefully everything will come together after we did this. So let me show you what. So this is something I did yesterday. I looked at Uber. So I looked at from the technical point of view. I did some fundamental and I looked at it, but technically it looked kind of attractive. By the way, I have to put disclosure again. Our classes are for educational purpose only. There is no recommendation. This is just the ideas I like to share. I have to use an example. I just want to use an example. So please just look at it as educational material. So this is something I did. At that moment, Uber was at $29.70. I looked at the moving averages, but something got my eye. First of all, I saw the as far as the support was about 2661. Based on Fibonacci, we looked at and we saw that the 50% was something right or under 26, about 2650. We are sitting right at the 38.2% at 2908, 06 we hit it. And then we are very much oversold in the stochastic. We're embedded, so it's not really, doesn't give us any confirmation yet. We want to go turn around and go up. So what I looked at, I said, you know, the ambush zone or the area between 61.8 and 50% is about $25. So that would be somewhere I would be comfortable owning this stock if it ever went down. So that was one thing. And then I also looked at the linear regression analysis, and this goes back 100. And I noticed, again, if it goes around 25, it is pretty oversold, and there's a chance that it could rebound. So the idea is, what is the chances of getting down there? Although, again, there's a selling pressure. It has been on Uber. So hopefully this option pane will explain exactly where we stand and how we can work on buying an option. So let me explain what's going on here. So this is Uber. At that moment that I was considering buying the option, it was at $29.73. So I looked at 30 days. I looked at September 18th expiration, and this is where we were, about 29. And remember, we are selling the put options. So if you recall, it's about $30, right? So what I want to do, I want to have the minimum of 30 cents collected. So I would disregard anything under 25. This is 20 cents. It's still close, so I would maybe consider a little bit, but I'd rather have something higher. The second thing I looked at was, I wanted to look at the delta. Delta is at minus 12. So when I come to like 28, I see it's at 31, but this looks attractive. So I have the premium. I also have a delta of 12. The open interest is 27,555, which is huge. So what that tells me, there's a lot of interest at that moment. That means market makers, and they're not going to let that go below that. So something will expire. And again, remember, the whole goal of selling option is you want to make sure it reaches, but it doesn't go beyond that. It will, at 25, I'm good. So it seems like I have partners in crime in this. The market makers are with it. The volume is at 628. That looks good. The THETA is 2 cents already. So that means every day that it passes by, the premium goes down by 2 cents. Remember, our goal is this thing going to zero. What that means, it's going to go to zero, so I can collect my 30 cents premium. Now, what happens, again, it's almost like an insurance company. Insurance company is hoping you will not have any accident and they're going to keep this $30 per contract. Then we look at, the other thing I look at is implied volatility. So implied volatility at this strike price is 54.54%. The historical volatility was about 52%. So we are above the historical volatility. The other thing was, what I was looking at is, what is the, I know I'm probably blocking this, but what this is called probability of in the money. So the probability of that strike price being hit at that moment is a little over 15%. So far we got almost every criteria that I had, it has been met. So basically, by meeting that objective, I went ahead, excuse me, I sold 5, actually I sold 10. So I sold 5 and I ended up with 10 contracts, which that allows me to have $300. And the way I did it, so let's say what you do, basically in order to sell it, you just click, this is from TradeStation, by the way. So in the TradeStation, you click on the bid, and what it shows, it tells you, all right, you have 5 quantity, always comes with limit. The limit price is at 30 cents, and it's good for the day, which was fine with me. And the mid is 31. So basically, I was happy with collecting 30 cents. So I went ahead and I changed it from 31 to 30, and I bought 10 strike prices at 25 at 30 cents, which is that I collected, or not I bought, I sold it for 300. When you see it's red and it's sold, so that means I collected $300, in this case $150 of premium. Now the question is, my maximum profit, as you can see, is $150. My maximum loss will be $12,350, because again the strike price is 25 minus, in this case, again, I have 5 contracts. So one contract would have been $24.70 times 5 would be 12,350. So I better have enough money in my account to cover for that. Would I be okay by owning Uber at 25? I was okay. But immediately what I did, as soon as I sold this, I went ahead. So I got multiple accounts. So this is like from TD Ameritrade. I did the same action in TD Ameritrade, or Thinkorswim. So I went ahead, it's a single order, buy to close. So I put my target. I showed one, but I do one different, each different price. So I was happy with 50% return on my money. So if I collected 30, I wouldn't mind buying it back at 15 cents. So I put a limit. This is the order type. Good till cancel. I always do good till cancel when I want to sell or I want to cover my profit. And obviously the expiration is September 18. At that time, the bid was at 31 cents. The price of stock was $29.65. So this is how immediately, again, I go ahead and put my profit targets. The goal is for that to go to 0, obviously, but I usually like to collect, I won't mind to cover at 1 cent or 2 cents, but I just want to show you this example that it's okay if I got 15 cents. Since we're on that subject, I think that the question has come up that what kind of a, as far as trading, as far as order types, what do we need to do? So most of you are familiar with the limit orders, but sometimes you have your profits go up. I mean, I've had, like, let's say SLV, and I've had it in a few of my accounts. This is one of them, my smaller accounts, my kids' account. So I bought them at $12. So just for our experience, I decided yesterday to put it like, okay, sell 1, and I want to use the trailing stop. So in TD Ameritrade, for instance, Thinkorswim, you go, you can either use trailing stop percentage. Let's say here you put down, if it goes down 10% from the time that this is in. So if it's 26.06, if it goes down 26 cents, sell it. If it goes to 27, if it goes down, I'm sorry, if it's 10%, $2.60. If it's 27, $2.70. So basically, this allows you to have your profits, you don't have to have turn your profits to a loss. I use 10%, but I wouldn't put 10% actually. I was just using that example, but because again, I've had it since $12. So basically what I did, instead of doing the percentage, I actually put it, you can actually do a dollar stop. In this case, I said 50 cents. So at that moment, the stock was at 26.05. We put down 25, so 50 cents out of 26.05 is $25.55. So it actually hit, it did go like to 26.70 or something, and I bought it. So this was sold at 26.20 yesterday at late afternoon, I think. So basically, I just want to show you this is the way you can actually do your trailing stop. And again, I always use put till canceled. When I put my profit targets, sometimes I even put down put till canceled plus, which is after hours. So it's important to do that because on the volatile stocks, it can move so much that you can actually it, all you need is like one time hit your target and then go back down again. This is something on TradeStation, the same thing. So I did the same thing. I put the 500 shares, a lot more shares on that one. You use, for trailing stock in TradeStation, use stop market. And I did it for the day just to practice, just want to go for this to see if it will hit it. And you just go to advanced, and then you do the trailing stop. In this case, I put $1. So if it went down $1, you could also use, again, you can use percentage. In this case, we use the price. So if it went $1 below, and where it was at 26.10, at 25.10, 500 shares would have been sold. So I thought it's important, just in case, just some of a logistic of doing things. So with that in mind, I hope it's a little more clear what is the purpose of selling options. Again, I use the Disney example. If you love a stock, let's say it's in the bottom of the channel, and you think, all right, this is a rectangular channel, or like a Bollinger Band you're using, and if you think, well, it's really expanded so much, it's gonna not come back in, the volatility is gonna get minimized. This is a good time. Maybe I would like to own this stock, which is, I feel fundamentally is a good stock. So why not own it? And at that time, you can, write options on it. On the weekly options, on the other hand, it's a little different. Usually you can use like 8 days. You have expiration. Let's say it's the following Friday. There's a lot of liquid stocks have weekly options. At that time, usually I would recommend, if you have next Fridays, give it 8 days. So I think Thursday or Wednesday of the previous week is a pretty good time to get in and start selling put options. At that time, again, the THETA starts really going down, but also you can use the same criteria, and it's all about probability again, right? So if you have your probability on your side, and this could be a really good strategy to collect premiums, as well as, again, buying the stock at your favorite place, that the price that you wanted to. One thing I have to also mention, and one thing I also like to mention is, as far as again these weekly options and other things, is you really want to make sure, like a day before, kind of before the expiration, you want to make sure you try to be out of it a day or 2 days. So if things can happen, again, the earnings, you want to make sure you're not there. Usually you have, unless you played, we talked about, we go back here, we're looking at the, for instance, the probability, the bands. So you want to make sure you're outside 2 standard deviation if you want to sell something. Again, it's all about probability. So if you have the probabilities on your side, then this is a very good strategy to make have extra income. And again, stick with your rules, follow your guidelines, and let's be successful. So what I'm gonna do, I'm gonna unmute. Let's see, everyone. I think everyone is unmute. Okay. And I'm gonna stop the recording in the meantime and ask everybody for questions. All right.